Good afternoon. Welcome to a special segment of Hedgeye TV featuring the restaurants and consumer staples sectors. My name is Shane Laidlaw. I'm an analyst on the team, and I'm joined by our sector head, Howard Penny. We're going to run through a number of our top ideas in both sectors, such as Chipotle, McDonald's, Darden, Kraft Heinz, Hain, and Snyder's Lance. As we go through the presentation, please submit any questions you may have in the QA box below the video online, and we'll be sure to get to them. Without further ado, I'll pass it off to Howard.
Thanks, Shane, and thanks everyone for joining us this afternoon. We'd love to take questions on any name that you've seen me talk about, or as you'll see on the list of names that we're actively following on slide 3. The Hedgeye Restaurant Best Idea list is comprised of our long names: McDonald's, Panera, Yum, Del Frisco's, and Zoe Kitchen. And then on the short side, we have Chipotle, Darden, Dave & Buster's, Buffalo Wild Wings, and Shake Shack. And of course, we're happy to answer any questions on any one of those names, and even the long bench or the short bench for that matter. But on the restaurant side, and we'll get to the staple side in a second, but on the restaurant side, we're going to focus on Chipotle on the short side and McDonald's on the long side. And why don't we just get right into Chipotle, since that's topical today. They put out a press release updating the street on sales for January and February and the early part of March, and things don't look good for them. Doing a lot of discounting, not getting much traffic, showing a little bit of improvement, I guess, in terms of what they're seeing in terms of sales. But for the most part, my view is that you can't discount your way to success, and you can't give away your food to success. So it's a drug, it's a narcotic, and people get addicted to it, and they want it, and then you stop giving it, and they don't come back. And so, it looks good when you're giving away food today and they're showing an improvement in traffic and getting people back, but it's just not a long-term strategy. So we'll have to see how that plays out for Chipotle. But one of the things that I'd like to talk about is one of the reasons why we were short prior to this event of November and the E. coli disaster that they felt in the fourth quarter, is that this company was essentially broken or headed down prior to this event, and the fact that their new store productivity and really their penetration into existing markets was greater than 50%, and they were seeing declining returns. So there was a whole host of issues that this company was facing prior to this, and I think this is masking it to a certain degree, or masking some of the problems to a certain degree. So that's why I feel very comfortable being short. I know we've got to play the slope of the line and the improvement in comps in the short run, going from down 25 to down 5 or whatever that may be, but they've proven so far that they haven't really done a great job managing through this crisis, and they don't have any experience in managing through this crisis because they've never been through this crisis before. I mean, they've witnessed other companies, but so if we could just turn to slide 4, I think you'll see what the street is looking for, and this is, I think to a certain case why the people might be long, is that you've seen, a down 14 comp to go to down 25 to 13 to 7, and then to a positive 6-7 in the fourth quarter. Now, that could happen, that may not happen. Who knows how that'll unfold? If it'll unfold exactly like that, it probably won't. But certainly, as you can see, the gold line is that 2-year average starts to improve. People are going to get excited about Chipotle and the company being fixed, and the stock will hover around 500, maybe not, maybe go down. But my guess is by the time we get out to the third quarter and fourth quarter, and you don't see the improvement in traffic and improvement in profitability, then the reality that the street's models, which you can see on the next slide, slide 5. Showing a significant improvement in profitability. Again, these are consensus estimates. These are not our estimates, but this is the bull case for Chipotle for the most part. So you had $15 in earnings this year, going to $8 or something less than that in 2016, and then nearly a doubling in 17, and then record earnings in 18, and then growing to 20 something and 20. And this is just not going to unfold this way. And I made a joke in the note that I wrote to the institutional clients today that if EBITDA goes from 600 million or 550 million to 1.1 billion in a 2-year period, I will eat at Chipotle every day for a year.
Do I have to join you with that?
No, you don't. You don't.
Maybe we can split it in half or something.
No, I will do it. I'll do it every day for a year. If Chipotle doubles its EBITDA, in 2 years from 16 to 18. I will eat there every day.
I don't think you'll
I'm not worried about that one.
No.
I'm really not worried about that one. But it's just not going to unfold this way. And I think the stock is levitating because there's a lot of people that want to believe in this management team. And I understand that they've built a wonderful company, but the fact of the matter is that they've also done a lot of damage to this company, and there's some long-term implications that have not been felt through the P&L yet, or is felt in the P&L, but you're not going to see a recovery in the P&L. So, but I just get back to what I said in the beginning. This is masking the real problem. This is masking the fact that they're growing too fast, and they continue to grow too fast in this downturn. So, and that's only going to exacerbate itself and manifest itself into a very challenging time for the next 12 months for Chipotle. But, we'll have to see how that unfolds. But I feel pretty good about it. If you want to turn to slide 6, so we're looking out at 2017 EBITDA and our little valuation matrix for Chipotle. And I think when reality sets in and you do see a recovery in the EBITDA, again, going from 500 million in round numbers to 800 million, which is still an enormous recovery in 17, and then you normalize the multiple for this company when people realize that they have to cut the growth rate and they got to slow it down, and comps are, or maybe we're heading into a recession, maybe not heading into a recession, but certainly they're not going to see the kind of comp growth that would imply that you need to have to get the kind of margin improvement that they're talking about. So you normalize the multiple for just any other normal restaurant company, and you can get anywhere from $295 to $400 stock. So it's down significantly from the current levels, but we're going to have to, a lot of things are going to have to unfold for that to happen. And of course, if things get worse and profitability gets worse and sales recover, same-store sales don't recover, then 11 multiple could be the peak, and it could trade at 8 or it could trade at 9. So it could go to, I put a number out there a while ago at 275, and I'm not coming off that 275, but there's a real possibility that 400 or something like that is in it. So I'd like to turn to. And again, if you have any questions on Chipotle, I'd be happy to take that. The next name I want to turn to is Darden on slide 7. This is a slide that we did in the deck, the Darden deck that we did a couple weeks ago, that shows that there has been a real improvement in profitability of the company as they've cut costs and improved same-store sales. But the fact of the matter is the Olive Garden is still broken. And to the degree that I measure a company or a concept being broken or not is the fact that they are generating positive traffic or not. And since the new CEO came in, Gene Lee, yes, traffic has gone from down 3.3% to down 1.89%, but it's still down and it's still negative. And if you look at the 0.6%, the 3.9%, and the 1.4% all in circles, you can see that those are the times that they did generate positive traffic, and that's when they did some discounting, and that's when they did the buy one, take one. So the only time they generate positive traffic is when they're basically discounting food, which is, just to go back to Chipotle in the third quarter, the only time Chipotle generated positive traffic in the third quarter when they did a buy one, get one free. So that, to me, was saying that it is a mature concept as well, but that's an aside going back to Chipotle.
And they just put out another buy one, take one, didn't they?
And they just put one out last month. They had good numbers this past quarter, cutting, they're cutting a lot of costs. They've got to go, they've got a calendar shift, they've got some things driving the sales, but the reality of it is the Olive Garden needs significant investment, and the company is not investing in the Olive Garden for a reason. And I assume that reason is don't expect to get an adequate return relative to what they can do just cutting costs and taking it to the bottom line. So this is one that'll play out over time. I feel really confident that I'll be right on this one. It doesn't look like I'm right today. But I know what needs to happen. I know what needs to happen to the Olive Garden. I know they need to invest in it. You cannot neglect the concept for 10 years. It's the kiss of death. And that being said, as I said, I'll be happy to take any questions on Darden, Chipotle. And then the last one I want to talk about is my favorite long, and that is McDonald's. And we've been on the McDonald's long for basically since July of last year. And there's a lot of reasons to like McDonald's. And one of the reasons why I like McDonald's today is because they are really doing a lot of things with the menu to simplify it, to focus on food away from beverages. The whole breakfast phenomenon and all-day breakfast has just been a huge win for the company, and they're continuing to see momentum this quarter. They're cutting costs. seeing positive comps, selling stores, and buying back lots of stock, the financial engineering. So everything that they're doing is driving higher margins, higher earnings, and it is a global company. It's clearly the biggest and best run concept out there. And they've got a new CEO and new motivation, and you can see it in in 2 slides on the global same-store sales. You can see on slide 8, as we're going to accelerate to 4%, or go from 5 to 4%, maybe even higher, kind of depending on what it is. But I would suggest that you could probably see something higher than 5% in the first quarter. And then if you turn to slide 9, what it looks like in the United States, they posted just a massive comp of 5.7% in the fourth quarter. 4.3 is probably a pretty good estimate for this quarter. Could be a little bit better than that, but I doubt they're going to do better than 5.7 in the fourth quarter. But this is what you want to see from a company the size of McDonald's, and the leverage that they have from positive comps around the world is just enormous to their infrastructure. So not a lot to add there, but certainly one name that I am not going to come off anytime soon, because it is really well run, and I love the name. Turning to slide 10, you can see the valuation matrix, kind of the same thing. We do the same thing for every restaurant company. We have a range of multiples and earnings depending on where you see things going, and 135 is the first stop, I think, for McDonald's, and then 150 is not out of the question over time.
What do you think is going to propel their next leg of growth? So they have a couple more quarters, a tailwind from all-day breakfast. They're trying to figure out their value play.
Yep.
Technology is kind of coming around, but where do you think?
So the big news for McDonald's has to be the value play. So they have to get that right. They've been struggling currently with that to a certain degree, but that's really important for them to get that right and to move forward with, and having to combat 2 competitors that are really aggressive with Wendy with the 4 for $4 and Burger King with the 5 for $4. So McDonald's is still working through that. It is a critical component. They say it every time they speak to the investment community, that they need to get value, but they don't need it today. That's the thing that's important. This is something that they can take their time and get it right, because there's enough momentum in the business for the next 2 quarters that they can really find something that resonates, and then it becomes a bigger sense of urgency, or becomes more of a sense of urgency coming into the first quarter of next year and into the first half of next year. So with that, I don't know if there are any questions on restaurants.
There are a ton of questions.
Why don't we take some questions on restaurants, and then we can move on to tables.
In regards to Chipotle, if the board believes shares are undervalued, why haven't we seen any insider buying? In this scenario, it seems as if the two would go hand in hand, unless they truly don't believe they are undervalued, therefore are misusing capital.
Yeah, no, that's a good question. They've said today they've bought back, I think since November, the company's bought back $780 million in stock. So, why management isn't buying, I don't know. They were just gifted, technically gifted, a ton of stock. Yeah. But I don't know. I mean, you would think that one of the first things management would do to say we feel good about our plan is to buy stock. But they're voting with the company's dollars, not their own dollars. Yep. So and that could be I think it could be a massive misuse of capital, frankly.
With that, so you talked a little bit about the slope of the line. All the bowls are kind of playing, specific to Chipotle, all the bowls are playing kind of the improvement story, that earnings are going to improve. But can you add a little more color to what the bowls are saying around Chipotle outside of just the slope of the line?
Yeah, no, it's 2 things. It's the slope of the line, and it's the earnings recovery. So if you go back to that slide of what the company's going to earn in 2018. I was down in Florida a couple of weeks ago at a big conference for consumer staples investors, and talked to a lot of people about Chipotle, and they constantly got this, you're not focusing on 2018 earnings. And I'm like, okay, I have no idea what they're going to earn in 2018. I think I have nobody knows what they're going to earn in 2018, but they're certainly not going to double their EBITDA in 2 years. I know that much. So if you think about the slope of the line and the improvement in comps, and then what that means for the trajectory of profitability, that's what people are saying. And that's what, and this goes into, Chipotle, the beloved Chipotle, the natural organic Chipotle, and, the changing of the making people think differently about how they're eating and whatnot, which, again, their gap when they started 10 years ago and they came public, their gap between the rest of the industry was really wide, right? Now they've had to come down, right, because they can't serve the type of same food they serve, and the industry's come closer to them. So not only the competitors are matching them, and they don't have that gap that they had anymore. So there's a lot of reasons why Chipotle is just never going to be the Chipotle that it was of the past.
Yeah. So talking about Darden a little bit more, we touched on it briefly. There's been a recent ramp up in the price. Obviously, there's been a kind of a squeeze in the market, and they released some decent numbers. But can you talk more about kind of the 9 to 12 month time horizon?
So they're in the fifth quarter of the turnaround and beating numbers significantly. And you know, if my timing was perfect, I would have thought about this in the same vein as McDonald's, right? Positive comps, cutting costs, beating numbers, stock going up, essentially, right? Mm-hmm. And that's what you're seeing with both McDonald's and Darden to a certain degree. But with McDonald's, the difference is McDonald's is doing something to revitalize the menu and improve the menu and improve profitability and improve, you know, the way the consumer perceives the food and the brand. With the Olive Garden, and that includes remodels and new menu boards and whatnot, with the Olive Garden, you have positive sales, you have cost cutting, you have the earnings beats, but what you don't have is reinvestment. You know, they're not doing anything to reinvest in the business. So the cost cutting and positive comps will run out of steam. I know they will, they always do. And if you're not reinvesting in the business, what do you have left over, right? And for me, that's a big deal, and we'll talk about that in this consumer staples space as well, because you know, if you're not reinvesting in your business, you know, then you're going to run into a wall. And the way I think about Chipotle, Darden and Olive Garden, it may not be the best analogy, but you know, it's like someone who's got a clogged artery, and it's just, you know, it gets worse over time. Then one day you wake up and you're in the hospital because you can't breathe. You know, and so, you know, they're going to stop breathing pretty soon, and they're going to wake up and they're going to have to reinvest in the business, and then all of a sudden the upside's gone. Yeah,
it's only a matter of time, really.
It's only a matter of time.
Yeah. So in regards to Chipotle,
and you have to. I'll just say this again. Yeah. You cannot not reinvest in your brand. You cannot remodel. Olive Garden has gone 10 years without a remodel program. 10 years. It's extraordinary. You've never heard of that in the restaurants.
And especially with how aggressive all their competitors are getting around remodels and improving the store.
Exactly.
So it's a pretty bad time to not be investing in your brands. Yeah. What are some past examples in regards to Chipotle of this type of illness outbreak in a restaurant? How long do companies take to return to profitable growth?
So in this day and age of social media, we haven't seen this. Yeah. So there's issues of people want to compare it to Jack in the Box, in the 90s and the late 90s and Taco Bell and the KFC disaster and the supply chain issue. So they're all a little different, but you know, even you saw in this where the media and social media drives consumer behavior and drives the perception of the brand, we haven't seen this. So I could be totally wrong, and consumer perception could be driven by social media and it could be fixed in 6 months. Or it could take 5 years because the brand, they're not doing what they need to do to change the perception of the brand, right? So it's hard to know, but you know, you'll know by the time we get to the fourth quarter, right? And if you go back to that chart that we showed where the estimates are currently for Chipotle's comps to be up 6% in the fourth quarter, which is a deceleration on a 2-year basis. If that actually happens, then that'll be the first sign that they're not fixing the business, and that they're not going to get back to peak margins and peak volumes.
Yeah, for sure. And then given it's topical, can you touch on the BAML conference, consumer conference today? What stood out on either a positive or negative side from Chipotle?
So, you know, Chipotle put their best foot forward, right? And trying to make them look like they're recovering and their sales are recovering. So they did a fantastic job there, and people love them. So that's good. McDonald's did a great job as well. You know, I think, you know, one of the things that they talked about was the Egg McMuffin being an add-on to a regular meal. So, you know, this whole all-day breakfast thing is, and to me, that's, McDonald's signaling that there's a lot of momentum in their business, and it's all day breakfast is really, really big for them. So.
Great. Well, we have probably a dozen other questions, so let's jump to staples and we can finish off the end of the call with the rest of them.
So on slide 11 is the best idea list for consumer staples. On the long side, we have General Mills, White Wave, Conagra, and Snyder's-Lance. And on the short side, we have Nu Skin, Kraft Heinz, and Hanes Celestial. And of course, happy to take questions on any one of those names. The first one I'd like to talk to, I guess, is slide 12, and that's the one that actually hasn't worked out too well for us this year, and that's the Snyder's-Lance. They've, ran into some issues, in terms of the Walmart clean store policies, and then other issues in the center of the store that a lot of companies are running to. But this really is a very strong small cap snack name. They've got a great distribution business, and I think it's short term, and short term meaning the last year has not been good for them. But they just bought Diamond. It's very accretive to the business. It's going to make this company a very attractive takeout candidate in 12 to 18 months, without a doubt. They'll recover from this. They've seen, sort of mid-single digit, low single digit volume growth. So this gets to what I like to see in both restaurants and consumer staples, where you've got good cash flows, improving margins, and reinvesting in the business and driving volume growth and not seeing declining margins. So, not too much to talk about there, but happy to take questions on that one. Because I think it is a great little small cap company. It's, we certainly have gotten on board on this one too early, but I don't feel too bad about it because I do think it's a great company, has great, long-term prospects. The one company that we've taken on recently on the negative side is Kraft Heinz. You can see on slide 13, the consolidated adjusted EBITDA margin, which is extraordinary by any stretch of the imagination for this industry and what they're doing. Just long and short of our thesis on the Kraft Heinz, I know that's got some very prominent shareholders and people running the company, but anybody else running this company, or if this was a publicly traded company without that, seeing their decline in revenues and volumes, it's not a good company. No. They've got, slide 14 actually will show you what the top line looks like, and part of our thesis is that they're not able to drive the top line, and their brands and their portfolio brands, which are stuck right in the center of the store, the morgue of the rest of the supermarket business, they're going to have a very difficult time. And if they get the cost cutting, they might be able to get the cost cutting, and or the offset and decline in revenues are going to offset some of the ability to cut costs. So I know I'm fighting a battle here, but I do believe that at the end of the day, zero-based budgeting is unproven to a certain degree, especially with these consumer companies where brands are important and the investing in brands are important. And we just don't know how this is going to end, but I think about the best companies in this space, and the best companies over a 20-year period in this space reinvest in the business and drive volume growth, and they don't see the kind of top line growth that KHC is seeing. So, but I know zero-based budgeting and cost cutting and getting a return on your expenses is the mantra of the day and what people want to talk about. But I think it's really it's an unproven business model for the most part, and we'll have to see how that works out. But I'm going to stick with my guns on that one. The next one on slide 15 is Hain. We've been short Hain for a while. I continue to think that this is a broken company for the most part. Their gross margins and SG&A, they're seeing, well, first of all, on slide 15, you can see, a constant decline in revenues, and I think they're going to have a very difficult time making the estimates in the back half of the year. And then on slide 16, you can see just that secular decline in gross margins, which is, again, if this wasn't a natural and organic company, or the largest natural organic company, and you were seeing, the move like this in gross margins, this company or stock would be destroyed. It has been destroyed, but it's still got further to grow. And then on slide 17, they've been able to keep their operating margins in place by just cutting SG&A, and there's just nothing left to cut. I mean, this is, the funny thing is about Hain, they came out with 6 months ago, really last 2 quarters have been very challenging for them, and they've now adopted the zero-based budgeting mantra when for the last 2 years on conference calls they trashed companies that were doing zero-based budgeting, saying, oh, we do zero-based budgeting all the time anyway, so we don't need to do it. Now they need to do it because guess what? Their revenues are declining, gross margins are declining, and they need to cut costs.
It's scary to think what they're going to cut.
It's really scary.
Not a lot left.
All the movements that they've made, the last 6 months to try to improve their costs have been disastrous, frankly. So, and then the last slide is slide 18, and that shows the adjustments, the total adjustments and the adjustments as percentage of net income. It was really bad there for a while, and in 15 it's come down and it's looked better, but this company abuses the adjustments to try to make themselves look good by reporting whatever number they want to report. So anyway, I guess that's the last one. Yeah. So with that, happy to take any questions.
All right, so sticking with Hain, when will we see a VRX type blow up in Hain?
Not soon enough. Well, it could happen. I don't think they make the fourth quarter. So their fourth quarter. So it's in the next 6 months, and in the next 2 quarters.
Great. Is Hain an acquisition target? And would you consider
No.
going long at any level near this?
No.
Yeah.
I don't know. First of all, if you think about companies in this space that have been acquired, right, or be able to cut costs and employ a ZBB strategy, right? Well, Hain doesn't have any cuts to cost. So if you buy it, what are you buying? You can't buy cost cutting. So what are you buying? You're buying the brands. Well, the brands are in a decline. The brands aren't competitive. They're in the natural channel basically, and who wants to buy into the natural channel? Especially a bunch of uncompetitive brands.
Like 70 of them or something.
I think then there's maybe 100 brands and only 10 of them might be worth anything. So it's just, and it's a turkey processor. I'd be shocked if someone bought this company. I'd be absolutely shocked. And we're short it, so we're making the bet that no one's going to buy this company.
I have a hard time believing anyone would want to deal with the integration process of this company. Thinking about bringing this mess into their portfolio.
And if you think about it, they've probably have over-earned over the last couple of years because they've been buying these brands and then stuffing channels, if you will, or stuffing the supermarket channel with organic products that essentially nobody's buying and or are uncompetitive and or seeing decline in gross margins because of the private label competition. So, what's the real earnings power of the company? Well, it's something less than what they've earned in the last year.
Yeah. You touched on this, just on Kraft Heinz, you touched on this briefly around margin expansion, but given the expansion of margins and margin levels over its competitors, it seems to this person that they deserve a premium multiple. Why don't you agree?
So it's about the sustainability of margins, right? And I would argue that they being 3G they cut costs at Heinz as a private company, and it came to a point where there was no more cost to cut. They had a hard time driving volume. So what's their exit strategy? Well, find another company to merge with and take a backdoor IPO. And now they're trying to do this again. So yes, they do have good margins, but in this business, you have to drive volumes. Volume growth is the only thing that matters. And if you don't have volume growth, you have to invest to get volume growth, right? And that means if your margins are high and your volumes are declining, that means your margins are too high and you have to reinvest and you got to bring your margins down. So those margins aren't sustainable because they don't have any volume growth. So to me, it's just so counterintuitive, I think, and this is just the way I think about companies, right? Companies with high margins and declining volumes say margins are too high, right? And you have to reinvest. So
is this an investable level for Snyder's-Lance?
Absolutely. Yeah. I mean, it's everything has come back. It's 28, might be 20. I don't know if it's 32.
It's like 31 right
31.
now.
Yes, it absolutely is. I mean, there's a lot of people who are really negative on this company now, and I mean, you want to be buying this into this negativity because it's too good of a company. I mean, who doesn't want to eat kettle chips and Cape Cod potato chips?
I mean, with a nice sandwich at lunch, who wouldn't?
Exactly. It's so good.
I think I saw you doing it today, didn't I?
No, unfortunately, we had the Terra chips.
No.
I did.
No. So someone saw Starbucks is on our short bench. Is it time to short it, or are we waiting for the right time?
I believe it's on the bench, but stay tuned. We're going to have a deck on that one.
Okay.
It's going to be a good deck, too.
We have a thoughtful comment from someone. Hain is a POS. Hope it goes to 0. Just for anyone that's not reading the Q&A, just thought I'd share that comment from someone.
It is a POS.
Okay, does the financial engineering at Panera concern you? Lack of ownership at management/CEO level.
Well, actually, if you think of Panera in terms of the entire restaurant space, that management team has more stock than anybody else. So, no, I think they're getting their house in order financially, right? Mm-hmm. So I like Panera a lot. I think it's seeing the back end of the investment cycle. So you're seeing an earnings acceleration story because the CapEx is starting to come down, or they're past 50% or when this year is over, they'll be past 50% of the investment in the Panera 2.0. So you should be able to see an earnings acceleration story, which is a positive. And you flip that around to Darden, right? So Darden is looking down that tunnel of investment. And anybody that knows Panera knows what happened to the stock is they were facing that tunnel of a big increase in CapEx to invest in the stores and what it did to the P&L. That's right where Darden is. And as soon as they flip that switch and decide they make the investment, that stock is going to get hammered.
Yeah. All right, so someone was pulling apart the Chipotle release. Could you discuss the effect of prepaying the $39.4 million of free burrito liability that they mentioned on the call? It does penalize Q1, but it benefits Q1.
Well, so they're pulling it forward. So they're putting out all these coupons out there. So they pulled forward some of the expenses from Q2 into Q1 because they have to put that liability on the books. Yeah. So that certainly could help. That certainly made, I think, Q1 look worse and will make Q2 look worse to a certain degree. But the bigger picture is, right, they're giving away a lot of free food. So what are they getting for that investment? Right? Are they going to get sustained traffic growth from investing $40 million in free burritos? I would argue that you're going to give. I mean, someone hit me up on Twitter and said he got his free burrito and gave it to the homeless guy
because he didn't want to eat it.
Because he didn't want to eat it. It's like, what are you getting from that investment? I mean, you have no idea what you're getting from that investment. Like it's to me, it's insane that they're spending that kind of money. And whether it hits the first quarter, second quarter, I mean, it's really it's important to understand where it's falling, and it's important to know that second quarter will look better than the first quarter. But it's all about return on investment, and there's a big investment in free burritos, and what's the return on that? Yeah. I would argue not much.
I think that's a great place to end.
Okay, good.
I think so. Everyone, thank you for joining us for this special segment of Hedgeye TV, and we'll catch you the next time.